Rahul, thanks for joining us for the Pinnacle Insight series.
Jared, thanks for having me.
Can we start with how you see emerging markets positioned right now versus developed markets? With everything that's going on in the world, we've just had the Trump inauguration, there's still so much geopolitical uncertainty, and inflation does still remain stubborn in many parts of the world.
So Jared, we are bottoms-up stock pickers, and we tend to focus on the underlying businesses that we invest in, and we try to not be driven by macro volatility and macro factors. Having said that, we are very aware of all the macroeconomic news and noise that exists. The way we see about emerging markets as an asset class is this is a very attractive long-term opportunity. There's very attractive growth in these markets. They are growing much faster than most of the rest of the world. The demographics are much more favorable. You are seeing more manufacturing and more sort of intellectual property coming out of these markets. And the valuations are very attractive as well, especially relative to the developed markets. So that's why we think emerging markets are an interesting place to deploy capital long-term. These are risky markets, however. There is a weaker rule of law and institutions. And so what we always say is let's look for businesses that are resilient and run by honest, competent families and entrepreneurs. And that's how we navigate a lot of the noise that you're describing.
Yeah, so I think you touched on it a little. We do have these attractive valuation opportunities, but we know Aikya is very selective about the stocks that make it into your portfolio. Apart from valuations, what are some of the other attributes you look for?
So we always start with quality first, and the way we define quality is a little bit nuanced and a little bit different. So for us, quality starts with quality of stewardship. So I alluded earlier that emerging markets do have weaker institutions and poorer rule of law. And what that means is, as investors investing in these markets, we have to do that job. The market is not going to do that job for us. So it is a big part of our responsibility, and our job is to look for businesses that are run by honest entrepreneurs, competent business owners, and sort of stay invested with them for the long run. So quality of stewardship, which is something most developed market investors are not used to studying, that goes quite mispriced in emerging markets, and that's where we look for most of our opportunities.
Yeah. And one of the top holdings in the Aikya Emerging Markets Opportunities Fund is a family-owned business, Uni-President Enterprises.
Yep.
Tell us about that.
So Uni-President Enterprises is our top holding. It is a Taiwanese business. So I'll just give you a very quick history of Uni-President Enterprises. So it was a typical Taiwanese conglomerate, run by a few families, and the main shareholder there was a person called Chairman Kao, and Mr. Kao, ran the business quite well for many years, but it had become quite diversified into several businesses that were unrelated. And the business was sort of mediocre in many parts and not generating high returns. Now, there was a generational change. So Mr. Kao's son-in-law, Alex Low, took over as CEO and then subsequently as chairman over the last 10 years. And what Alex Low has done is he's gotten rid of a lot of the unrelated businesses, and he's focused the business around 2 or 3 verticals. So the first vertical is the retail business, which is primarily 7-Eleven stores, convenience stores in Taiwan. And with the success they've had with Taiwanese 7-Elevens, they dominate the market with convenience stores in Taiwan. They've also had similar success now in Philippines, and that's a long-term growth story. And they are in the process of rolling these out in some geographies in China. Within Taiwan, they've also gone into other formats in retail. So they recently acquired the Carrefour operations. And so just collectively, this is a very strong food retail operation. The second business they have is a food and beverages business. So here they manufacture products like instant noodles and beverages like tea, milk tea, green tea, those kind of ready-to-drink products. And those are very strong in Taiwan. And they're increasingly becoming popular and strong in China, run by a completely localized management team in China under Uni-President China. And then they have a very strong logistics platform, especially within Taiwan. and they're increasingly leveraging that for e-commerce. So they already have the 7-Eleven capillarity. So if I order anything on an internet platform in Taiwan, I can have it delivered at the nearest 7-Eleven and pick it up. But now Alex Lowe is going a step further, and he's recently made acquisitions in Yahoo, Taiwan, as well as one of the leading Taiwanese internet companies, and they're putting together their own internet solution. They already have a very loyal customer base that uses the app and gets loyalty programs every time they shop at a 7-Eleven or drink coffee at a Starbucks, and all the different affiliates they have. They can leverage that entire traffic onto their e-commerce platform, and that is something that we're sort of watching with anticipation over the next few years. So this is a classic example where Alex Lowe and family have, it's not just skin in the game, they have soul in the game. And their entire, not just net worth, but self-worth is defined by Uni-President Enterprises. And so for us investing in them, we know they are honest, we know they are competent, and we can just sort of stay invested with them for a very long time because of how good a business it is.
Yeah. China's recovery, one of the biggest topics in emerging markets right now. What does Aikya's exposure to China look like as we move into 2025?
Yeah. So, we are... aside from quality investors, we are also focused on valuation. What that means is we tend to be quite contrarian. So when the rest of the market seems to be, panicking about a region, which gets reflected in valuations, we usually take advantage of those opportunities. And if there's a business that's on our quality list that's out of favor, as long as the quality is still intact, we take these opportunities to increase our exposure. So China has been a market where over the last 18 months or 24 months, we've significantly increased our allocation. So we've taken our weighting in China from around 5% in 2020 to close to 28% now. So it's been a significant increase in China exposure. One such holding that I can name is Foshan Haitian. It's one of our largest positions in China. Foshan Haitian is the leading soya sauce manufacturer. And so the question we often get asked is, how do you invest in China given all of the government involvement? Now, soya sauce is not on the top of the CCP's agenda today. And the business that Pang Kang and his fellow senior management have built in Foshan Haitian is a very interesting one. So it is the leading soya sauce manufacturer. They have the largest market share. They have the best brand. They have the best distribution. Soya sauce is still in China going through a formalization process. So traditionally, everyone in China would have soya sauce on their tables, on their dining tables. You would be buying it from an informal channel that uses a cottage industry type process, like acidification process. And this is being industrialized by players like Foshan Haitian, using a more fermentation, healthier process. The more scale you have, the lower cost you are, which is where Foshan Haitian is positioned. They can then leverage their distribution with other products. So if you're strong in soya sauce, you could also, and they have, be strong in oyster sauce, vinegars, and then eventually premiumize, launch variants which are healthier, lower sodium, lower MSG or no MSG, and eventually look at international expansion. So this is a business we think has very, very long growth runway ahead of it. It's a very well managed business. It did have some trouble during the during COVID because half their products are sold in restaurants, half go to homes. The restaurant side of it was completely disrupted and it was a bit of a mess. So they've cleaned up all of that distribution over the last year and a half. And we're now sitting at a point where it looks quite appealing from here.
Yeah. So we've covered a lot of ground, some of the key regions. Just finally, is there one under the radar emerging market that you and the team is finding interesting right now?
So, we keep an eye out on several markets, especially markets where we think the institutional quality is strong enough for us to be able to find genuine private entrepreneurs. So I can talk about South Africa as one of these opportunities where we recently wrote a quarterly letter on a company called Capitec Bank. Capitec Bank is a bank that was set up a little bit more than 20 years ago or 25 years ago by a group of entrepreneurs who had experience not in banking but in retail. And what they were trying to do in South Africa was disrupt the traditional banking landscape. So, South Africa had a banking system where 4 banks dominated the industry, and they were very cozy, very comfortable oligopoly. But that came at the cost of servicing the customers. So the customer experience was quite poor, and the high-end customers were being sold over-engineered, expensive products, and the low-end customers were being ignored. Capitec built their entire business starting with the low-end customer, selling them a very, very simple, no-frills, low-cost, simple banking product. And over the years, they've sort of moved up the sort of economic curve, and they found that there's a lot of broad appeal even in the higher income segments for a product that is simple, no nonsense. And now, because of their simplicity, they're in a prime position to embrace things like the fintechs and the payments, online payments, and online banking, and extend that into creating an ecosystem. And that's where Capitec is right now. So it's run again by a very able group of entrepreneurs. We have very high confidence in the current management team, as well as the founder Michel Leroux, who's still on the board, and some of the folks from PSG Group that backed them very early, that are still involved in the board of directors. And we think it's a well-governed, a very competent business that is, in a geography that a lot of people don't necessarily spend a lot of time on.
Rahul, thanks for all those insights. It's always great talking to you.
Thanks, Jared. I mean, it's been great for us to meet with investors in Australia recently, and we'll be back again this year as well.
Great.
Thank you.